Okay, let's dive right into this explainer because we are going to completely dismantle everything we've been taught about the so-called responsible way to buy a house. Look, if you've ever listened to a financial guru, you've probably heard that paying off your mortgage as fast as humanly possible is the ultimate sign of financial maturity. But what if the math tells a completely different story? Does a 15-year mortgage actually cost you hundreds of thousands of dollars? I know, it's a shocking question, right? We are so conditioned to believe that a 15-year mortgage is the absolute holy grail of disciplined personal finance. The shorter the loan, the less interest you pay to the bank, and the sooner you own your home free and clear. I mean, it just feels right. But today, we're going to look at the hidden math beneath that assumption. And I promise you, by the end of this, you're going to look at your monthly mortgage payment in a totally different light. To start off, let's be fair and give both traditional arguments their shot. Because honestly, neither side is stupid, they're just kind of incomplete. The 15-year mortgage is your classic disciplined choice. You usually get a lower interest rate, often half a point or more below the 30-year. You build equity lightning fast, you pay drastically less interest, and boom, in 15 years, the bank is out of your life forever. On the flip side, the 30-year mortgage is the flexibility choice. Your required monthly payment is significantly lower. So if you lose your job, face a medical emergency, or need to pay college tuition, you aren't being strangled by this massive mandatory payment. Both make total sense on the surface, but they are both missing the exact same invisible variable. Let's bring this into the real world with two buyers, Jake and Marcus. They're buying the exact same $400,000 house, putting the same 80 grand down, which leaves them both with a $320,000 loan. Jake, he goes all in on the disciplined 15-year path at a 6% interest rate. His monthly principal and interest payment is pretty steep, about $2,700. Marcus takes the 30-year path for a little breathing room at 6.5%. His monthly payment is way lower, coming in at $2,022. And Marcus tells himself that he's going to invest those savings. So the absolutely crucial point here is this specific number, $678. That's the exact mathematical difference between Jake's 15-year payment and Marcus's 30-year payment. I want you to literally burn this number into your memory right now, because that $678 is the pivot point of our entire analysis. It's not just a monthly savings, it's the entire battleground where this financial war is won or lost. And that brings us to the third path. The path the gurus basically never run the math on. Meet Mia. Mia buys a similar house with the exact same loan terms as Marcus. She takes the 30-year mortgage with that lower payment, but Mia does the one thing Marcus only talked about doing. She actually invests that $678 difference every single month. She automates it right into a broad market index fund. Let's see what happens to all three of these folks after 15 years. By year 15, the numbers tell a pretty wild story. Jake's mortgage is completely paid off. Assuming a conservative 3% annual home appreciation, his house is worth about $646,000. But he has zero invested assets from this strategy because every spare dollar went straight into the house. So his net position is $646,000. He looks like the clear winner, right? Now, Marcus is a behavioral disaster. He didn't consistently invest the difference. You know how it is. Life got in the way. A vacation here, car repairs there. He only has $30,000 invested and still owes $235,000 on his house. His net position is lagging way behind at $441,000. But look at Mia. She owes the same $235,000 as Marcus, sure. But because she automatically invested that $678 at a historical 7% return, she has $215,000 sitting in liquid assets. Her net position is $626,000. Jake is still slightly ahead by about 20 grand. And guess what? This is exactly where the financial gurus stop their analysis. But here is the fatal flaw in all that conventional wisdom. Year 15 is not the finish line. Year 30 is. Remember, we're comparing a 15-year strategy to a 30-year mortgage. To find out who actually wins, we have to run the math all the way to the end of the 30-year horizon. So let's fast forward another 15 years. Now comes the staggering twist at year 30. From year 15 to 30, Jake finally starts investing his old $2,700 mortgage payment. But Mia just keeps doing what she's been doing. She keeps paying her mortgage and investing her $678. But critically, that $215,000 she built up in the first 15 years, it spends the next 15 years compounding beautifully in the background. By year 30, Jake's total net position is $1.68 million. Mia's total net position? $2.29 million. Mia didn't just beat Jake, she absolutely crushed him. That is a raw, cold hard difference of $610,000. Just let that sink in for a second. Same house, same down payment, same total income allocated to housing and investing. But simply by choosing the 30-year mortgage and automating the monthly difference into an index fund, Mia walks away over $500,000 richer than the guy who aggressively paid off his debt. No way, right? So how is this even possible? Let's break down the hidden mechanics making this happen. It all boils down to one critical concept: opportunity cost. When you take out a 15-year mortgage, you aren't really just saving on interest. What you're actually doing is forcing yourself to invest your money at a guaranteed return equal to your mortgage rate. When Jake poured his extra $678 into the house, he basically bought an asset returning exactly 6%. That's his rate. And by the way, it's tax disadvantaged because as he pays down the loan, he loses his mortgage interest deduction. Meanwhile, the historical real return of the S&P 500 after inflation is about 7%, and it's closer to 10% before inflation. The 15-year mortgage forces you onto the lower return path. Mia simply chose the higher return path. Beyond just the returns, there is the inherent danger of the asset class itself. A house is a highly illiquid asset. When you aggressively pay down a mortgage, you are trapping an enormous portion of your wealth, quite literally, inside the walls of your house. If you lose your job and desperately need cash, you cannot buy groceries with drywall. You either have to sell the house, which is incredibly slow and expensive, or get a home equity line of credit, which banks historically love to freeze exactly when recessions hit, or do a cash-out refinance at whatever the new, potentially terrible interest rates are. A paid-off house is not cash. And this brilliantly illustrates another massive advantage Mia had: inflation. A fixed-rate mortgage is one of the only assets in the entire financial system that actually becomes cheaper to pay as time goes on. Your payment stays exactly the same, but inflation constantly erodes the value of the dollar. That $2,022 payment feels super heavy in year 1, but by year 25, after 2.5 decades of inflation, it feels like pennies in real terms. A 30-year mortgage locks in 30 solid years of inflation protection. A 15-year mortgage cuts that massive financial advantage in half. Which brings us to the ultimate power of optionality. The 15-year mortgage is a rigid, one-way commitment. If your life completely changes tomorrow, an illness, a divorce, a sudden job loss, that $2,700 payment does not care. It remains rigidly unchanged. The 30-year mortgage, however, preserves your options. You can always choose to pay extra. You can treat it like a 15-year mortgage voluntarily if you really want to. The 30-year gives you choices. The 15-year takes them away in exchange for a feeling of discipline. But look, we have to be brutally honest here. The gurus aren't entirely crazy because the math only works if you actually invest the difference. And most people out there are like Marcus. Marcus's failure wasn't a lack of moral character. He just fell into the behavioral trap of manual execution. When you have an extra $678 sitting in your checking account, life just absorbs it. The kids need things, the car starts making a weird noise, you want to take a weekend trip. None of it is reckless, it's just life. Manual execution almost always fails. So, how do we build an actual bulletproof solution? You don't need more willpower, you need a system. Here is the 6-step automation playbook to become Mia. Step 1, choose the 30-year mortgage. Step 2, use a calculator to find the exact mathematical difference between your 30-year payment and what the 15-year would have been. Step 3, and honestly, this is the magic step. Set up an automatic monthly transfer for that amount on the exact day after your mortgage clears. Step 4, direct it into a low-cost, broad market index fund. Step 5, do not touch it for 30 years. And step 6, as a pro move, scale that transfer amount up as your income grows over your career. Now I know exactly what you are thinking. It's the most common objection to this entire strategy. But what happens if the stock market crashes? It's a completely valid fear. Over a 30-year timeline, you are absolutely guaranteed to see recessions, bear markets, and panic. So how can we rely on the math of the stock market to beat the guaranteed return of just paying off the house? Well, let me point you to this staggering quote directly from our source material. There has never been a 30-year period in U.S. equity history with negative real returns. Think about that. That includes the Great Depression, that includes the dot-com bust, that includes the 2008 financial crisis. Over every single rolling 30-year window, the market has recovered and delivered. This strategy isn't built in spite of market crashes. It literally assumes they will happen, and it relies on the historical certainty of the long-term recovery. The second big objection we hear is entirely emotional, and it's heavily pushed by traditional financial gurus. But what about the peace of mind of sleeping under a roof that you completely own? Look, there is an undeniable emotional appeal to having no mortgage. It feels safe. But we have to separate how things feel from how things actually function in a real-world emergency. True financial peace of mind does not come from a paid-off, illiquid asset. It comes from liquidity. It comes from options. If the economy tanks and you lose your income, Jake has a paid-off house, but he has zero cash to buy groceries or pay his property taxes. Mia still has a mortgage payment, sure, but she also has a liquid brokerage account with over $200,000 in it at year 15. She could literally pay her mortgage out of that account for a decade if she absolutely needed to. The brokerage account is what actually bails you out. The house, that's just what you live in. Which brings us to our final thought for today. The 15-year mortgage is the choice you make when you simply don't trust yourself to be disciplined. But the 30-year automated investing strategy, that's the choice you make when you deeply understand the mechanics of wealth. So, I'm going to leave you with this. When you look at your own finances, are you choosing the strategy that merely sounds the most disciplined to your friends and family, or are you brave enough to choose the one where the math actually works?